Joining me now to talk more about the markets is Todd Stankiewicz, co-portfolio manager of the free markets ETF from White Plains, New York. Todd, welcome back. And let's get your take in terms of what our viewers need to know as we embark on what is set to be a very busy week for market action.
Yeah, normally I would say we just want to look at the jobs data, and I think ADP is going to be important on Wednesday, and then payroll data on Friday. But really what we're dealing with right now is a looming government shutdown, which would occur Tuesday night. And I think normally the market's just kind of glazed over these a little bit. It's been a lot of hype and hasn't turned out to be a lot. But this particular situation could be a little bit of a bigger deal because that jobs data, that employment data, with the exception of ADP, won't come out if we have a government shutdown that goes through Friday. And with the market hanging on every word right now and every data point, they're going to be looking to see if this Fed rate path is going to hold tight based on the employment data.
Yeah, what is your expectation in terms of the Fed rate path going forward? The prescription here is we only have a few more meetings left this year.
Yeah, I think the Fed's been pretty clear they're going to give the market what they were looking for, which is 2 more rate cuts this year in October and then December. And really, I think the big change was a shift in 2026, where essentially we're going to see, where the Fed's telling us we're going to see 1 rate cut, but the markets are still expecting 2 rate cuts. I think a Fed rate cut in March and then another one in September. So the market is still being a little hopeful that the Fed's going to take on an easier monetary policy stance than they're literally telling us they're going to do right now.
Interesting. And in terms of inflation, it continues to be sticky. We did see that the S&P 500 gained about 0.6% on Friday. It was a down week, but that was inline inflation, still 2.9%. That is above the Fed's long-term 2% target. What does that mean for overall economic growth and how you anticipate corporate America will be able to navigate it?
Yeah, I think the interesting thing about inflation is that the market is trying to adjust their terms, and they're banking on the fact that the Fed will as well, basically moving off that 2% stance and looking at maybe they're okay with a 2.9 or a 3%. I have a little bit of a different view on this because I view basically that with the Fed taking easier monetary policy right now, that could spur some demand. But really what we look from the federal government is that they're pushing through a big regulation shift right now with a lot of executive orders and legislation. In theory, this could spur supply, right, as we bring more competition online. And I think potentially this could combat inflation right now. So I think it could put us into a little bit of a Goldilocks growth pattern where we have growth, but we don't have spiraling prices.
Interesting. And in terms of sectors that could outperform in this type of environment, Todd, what are you watching?
I think we got to look at areas that are benefiting from that deregulation. So what we look at is industrials, energy companies, even some utilities, which have traditionally been some laggards here, but we started to see those kind of peak up last week and start to make some moves. So those are the areas that we're watching, and those are the areas that I think that investors should be watching right now.
Todd Stankiewicz, co-portfolio manager of the free markets ETF. Thank you so much for joining us this morning.
Thank you.